We just witnessed one of the most violent shakeouts in precious metals history. And if you're sitting there wondering whether everything you believed about this bull market just died, stop. What you're seeing isn't the end of anything. It's the beginning of the next phase, and most people are going to miss it because they're too busy panicking over the wrong things. I'm about to show you exactly what happened beneath the surface, why the fundamentals haven't changed one bit, and what comes next. But first, drop a comment right now. Tell me what date you're watching this and where you're watching from. I want to see how global this community really is. And if you're new here, hit subscribe because we're diving deep into the mechanics that actually move markets. Here's what just went down. Gold was touching $5,600 an ounce, all-time highs. Silver blasted past $100 for the first time in a generation. Everyone was celebrating, rocket emojis everywhere. Then Friday hit like a sledgehammer. Gold collapsed 11% in a single session. Silver got destroyed even harder. By Monday morning, gold was scraping $4,500 and silver was limping around $75. Absolutely brutal, zero mercy, and the panic was instant. The mainstream narrative? The Fed held rates steady, the dollar strengthened, and Kevin Warsh's nomination as the next Fed chair supposedly spooked the market. Sure, those factors mattered. But if you genuinely believe a rate hold and a nomination explain an 11% annihilation in gold and a comparable massacre in silver, you're missing the entire story. Headlines give you convenient explanations. Mechanics give you the truth. And the truth is, this was a forced liquidation event driven by margin squeezes that had been building pressure for weeks. Let me break down what actually happened. When volatility explodes, exchanges panic. They don't want over-leveraged traders imploding and sticking them with the losses. So they jack up margin requirements, forcing traders to deposit more cash to maintain the same positions. Can't come up with the cash? You get liquidated. Your position closes whether you agree or not. The Shanghai Futures Exchange cranked margin requirements to 19% on gold and 22% on silver, while setting daily price limits at plus or minus 17% for gold and 20% for silver. Sounds like breathing room until you realize that when you're leveraged, those ranges can obliterate your position before you can even react. But Shanghai wasn't alone. The CME group, which dominates Western futures trading, also hiked margins last week. Now you've got the world's two largest exchanges simultaneously making it exponentially more expensive and dangerous to hold leveraged precious metals positions. When that happens, traders don't sit around philosophizing about fundamentals. They slash exposure, they close positions, they exit. Not because their conviction died, but because the cost of staying in the game just skyrocketed, and the risk of getting caught wrong became unbearable. This is what I mean when I say the real story lives in the plumbing, not the headlines. The Fed and the dollar and the nomination, those are the narratives. But the actual selling tsunami came from leveraged traders getting crushed by margin hikes. It's mechanical. It has nothing to do with whether silver is worth $100 or $75. It's about who can afford to stay in under these new, brutal conditions. And a lot of people couldn't. Think of margin requirements like a boa constrictor. They don't kill instantly. They squeeze tighter every time you exhale until you can't breathe anymore. That's what's happening to speculative positions right now. Every margin hike is another constriction. Every volatility spike is another breath lost. And unless you're sitting on a mountain of cash, or you're completely unleveraged, you're suffocating. Does this mean the bull market is dead? Absolutely not. But we've shifted phases. The easy part where everything rockets higher and everyone's a genius, that chapter closed. Now we're in the phase where markets separate tourists from locals, where weak hands get violently shaken out while strong hands quietly accumulate, where patience and proper position sizing matter infinitely more than enthusiasm and conviction. Let me give you perspective. Over the past 12 months, gold is still up approximately 66%. Even after this carnage, gold has crushed nearly everything else over the year. It peaked at 90% gains, now sitting at 66%. Still extraordinary. Silver? Up 139% over the past year. At the peak, it was up 255%. Yes, we've surrendered significant gains, but we're still massively profitable on any reasonable time frame. The problem is, most people don't think in time frames, they think in peaks. They anchor to the highest number and measure everything from there. If you bought silver at $30 a year ago, you're still up 250% at today's prices. But if you chased it at the peak when everyone was screaming about the moon, you're down 30% and panicking. Same asset, radically different experience. The difference? Timing and position sizing. The market teaches this lesson on infinite repeat to anyone willing to learn. Now here's something critical that's being ignored. Short interest in silver miners just hit an all-time record high, $2.4 billion. That's billion with a B. First time in history, short interest in this sector topped $1 billion, and now it's more than doubled that. What does this mean? Massive money is betting against silver miners right now. This creates two scenarios. If shorts are correct and silver keeps falling, they profit and selling pressure continues. But if silver stabilizes or climbs, those shorts become rocket fuel for the next rally, because short sellers eventually must buy back borrowed shares. When you've got $2.4 billion in short positions that need covering, any upward move can trigger a violent squeeze as shorts scramble to close before losses spiral. We're already seeing movement. There's been $192 million in short covering so far in 2026. Shorts are trimming positions. First Majestic Silver and Discovery Silver have seen the most covering, signaling smarter shorts recognize the risk-reward has shifted. They don't want to get caught wrong if this pullback becomes a launching pad. But not everyone's covering. Silvercrest Metals actually saw increased short selling. Disagreement. Tension. Some exiting, others doubling down. This creates the volatility battlefield we're navigating. Let's address the fundamentals, because it's easy to lose sight in short-term chaos. The structural story for silver hasn't changed. Global mined production sits around 820 million ounces annually. Annual demand has pushed past 1.2 billion ounces. That's a deficit of nearly 400 million ounces every single year. The crash didn't fix this. Margin hikes didn't fix this. Short sellers didn't fix this. The deficit persists, consuming available inventories, creating pressure that will eventually manifest in price. Demand is only intensifying. Solar panel manufacturing is ramping globally as governments pursue decarbonization. Electric vehicles need silver for electronics and battery systems. 5G infrastructure requires it for superior conductivity. And here's the demand driver most people still aren't pricing in: artificial intelligence and data centers. Silver has the highest electrical and thermal conductivity of any element on Earth. When you're running AI chips at speeds that were science fiction a decade ago, that conductivity becomes non-negotiable. Copper works for many applications, but at AI speeds you need silver plating and silver interconnects to control resistance and heat. These demand drivers don't care about the Fed. They don't care about margin requirements or last week's dollar action. They're structural forces reshaping global silver demand while supply struggles to respond. Mining projects take a decade to develop. Permitting is nightmarish. Ore grades are declining across major regions. Capital markets remain cautious about funding new exploration. Demand accelerating, supply struggling. That's the formula for higher prices over time, regardless of weekly or monthly noise. So why did silver crash if fundamentals are so strong? Here's the answer. Fundamentals tell you where price goes over time. Positioning tells you where price goes short term. Right now, positioning is messy. Leveraged longs got washed out. Shorts are at records. Margin requirements are squeezing participation. The market is confused, trying to figure out what to believe. This is normal in bull markets. They don't climb in straight lines. They shake you, test you, make you question everything. Then, once they've eliminated everyone who shouldn't be there, they resume the trend. I'm not claiming the bottom is in. We could go lower. Silver could test the low 70s, or even dip into the 60s with another liquidity event. Gold could revisit $4,300, or even $4,100 in a severe shakeout. But ask yourself, did the deficit disappear? Did AI data centers stop needing silver? Did solar manufacturing shut down? Did central banks stop accumulating gold? Did global debt suddenly get paid off? The answer to all of these is no. So if the fundamental reasons for owning metals haven't changed and only the price changed, what does that mean? You're either getting a better entry point or you're getting scared out of a position you should be building. The gold-silver ratio remains elevated by historical standards even after this crash, telling you silver still has room to outperform gold percentage-wise if the bull market resumes. The catch is, silver's volatility cuts both ways. When things are good, silver runs harder. When things are bad, silver falls harder. That's why position sizing in silver needs to be more conservative than gold. You're accepting more volatility for potentially higher returns. If you can't stomach that volatility, silver will punish you emotionally before it pays you financially. Quick pause, where are you watching from right now? Drop your location in the comments. US, Europe, Asia, South America, Africa? Let me know. And tell me, are you using this pullback to add or waiting for more clarity? I genuinely want to know how this community is positioned. For gold, watch the $4,900 to $5,100 zone. If gold reclaims and holds $5,100, buyers are stepping back in and the worst liquidation might be over. Above that, resistance sits around $5,300, then $5,450, then the all-time high at $5,598. Downside, if $4,900 fails, next stop is $4,800, then the February 6th low around $4,650. A break below signals something more serious. For silver, the key upside level is $84. Clear that with conviction, and we target $92, then $95, then back toward triple digits. Downside, $79 has been defended. Below that, $75 is critical. Lose $75, and we're staring at a potential retest of $64. Painful, but probably a generational buying opportunity for those with dry powder and patience. Here's what bothers me about reactions to this crash. People treat every pullback as either nothing or everything. Either it's just a dip to buy or it's apocalypse to sell everything. Neither extreme helps. Reality is messier. Better framework. Ask yourself what has changed, not the price. Price is just a number. What actually changed about why you own this asset? If you own silver for the structural deficit, has that gotten worse or better? If you own gold hedging against currency debasement, has government suddenly become fiscally responsible? If you own miners for operating leverage, has that math changed? Usually the answer is no. Reasons haven't changed, only price changed. If your thesis is intact but price is lower, that's not panic territory. That's evaluation territory for potentially adding at better prices. Of course, this assumes correct sizing. If this pullback is costing you sleep, you were sized wrong. Not morally wrong, strategically wrong. Position sizing isn't about how much you believe in something. It's about how much you can lose without affecting judgment. If you're staring at red numbers making you irrational, cut back to a size that lets you think clearly. Here's what I think happens next, and this is opinion, not prophecy. Nobody knows the future. Anyone claiming certainty is lying or delusional. But based on what I'm seeing, we're probably entering consolidation. Choppy, frustrating sideways action that angers both bulls and bears. Bulls get excited on every bounce, then watch it fail. Bears get excited on every drop, then watch it find support. This is what markets do digesting massive moves. They need time to reset positioning, wash out weak hands, find new equilibrium. This could last weeks or stretch into spring. If you need daily fireworks, you'll hate it. But consolidation is where trends reload, where the next move gets built. Use it, scale into weakness, keep dry powder for deeper shakeouts. Don't try timing the exact bottom because you won't. Let's talk miners because this is where leverage lives. When silver was $30 a year ago, average all-in sustaining costs were $20 to $25, leaving margins of $5 to $10 per ounce. Miners made money but nothing exciting. At current prices, even at $75 silver, you're looking at margins of $50 or more per ounce. That's 5 to 10 times the profit on a 2.5 times move in the metal. That's operating leverage. Why mining stocks can outperform metal when things go well. But it cuts both ways. If silver drops toward costs, those margins evaporate and stocks get crushed. The Global X Silver Miners ETF is up 180% over the past year, even after recent drawdown. That's outperformance versus the metal with more volatility. The ETF is down almost 10% from January peak versus silver's 30+% decline. Relatively strong performance, suggesting the market is giving miners credit for the earnings explosion they're about to report. We're heading into earnings season. When miners report Q4 and early 2026 numbers, investors will see cash flows that are multiples of a year ago. The math is undeniable. When math hits financial statements, valuation models must adjust. Either stocks rise reflecting new cash flow reality, or metal prices fall destroying those margins. Given the structural deficit, I know which outcome I'm betting on. What just happened was brutal. But underneath the noise, fundamentals haven't changed. The deficit persists. Industrial demand grows. Central banks keep accumulating. The reasons people started buying metals haven't evaporated from a bad week. So here's your question. Are you a tourist or a local? Tourists show up when things are exciting and leave when things get scary. Locals understand volatility is the price of admission and stay for the long game. I'm not telling you to blindly buy the dip. I'm telling you to understand what you own and why. Size your position so you can think clearly when markets scream. Have a plan that doesn't depend on feeling good, because the best opportunities usually feel the worst, and the biggest traps usually feel the best. Here's what I need from you. Comment below. Are you adding on this pullback or waiting for clarity? Do you think we've seen the worst, or is more pain ahead? What's your time horizon? Weeks, months, or years? Drop your answers. Let's build a real conversation. And if someone you know is staring at their portfolio, wondering what just happened, send them this video. Give them context instead of letting them drown in noise. The crash was real. The pain was real. But bull markets don't die this easily. They shake you, test you, make you question everything, then reward those who stayed rational, sized correctly, and focused on what actually matters. Silver at $75 after hitting $100 isn't the end of the story. It's a chapter. The question isn't whether the story continues. The question is whether you'll still be around to see how it ends. Stay sharp, stay humble, and I'll see you in the next one. This is educational content, not financial advice. Do your own research, make your own decisions, and only take risks you can actually afford to lose.